The truth about no-doc loans, the investment loans most banks don't want you to understand. Have you ever heard someone say you don't qualify because your tax returns don't show enough income? Or maybe you're self-employed. Maybe you own multiple rental properties. Maybe your CPA has done such a good job minimizing your taxes that now the banks say you don't make enough money to buy another investment property. If that's you, today may completely change how you think about financing real estate. Because today we're talking about no-doc loans, specifically DSCR loans, no-ratio DSCR loans, how they actually work, who they're designed for, the pros, the cons, the hidden costs, the myths, the real examples, and when they make sense and when they absolutely do not. By the end of this video, you'll know enough to have an intelligent conversation with any lender in America. Let's jump in. First, what does no-doc actually mean? Let's clear up one of the biggest misconceptions first. When people hear the words no documentation loan, they immediately think, wait, I don't have to provide anything? No. That's not what it means. These aren't the infamous liar loans from 2006 when someone claimed they made $5 million selling lemonade. Those days are over. Today's no-doc loans are completely different. The lender absolutely verifies your identity, your credit, the appraisal, the title, assets for closing, reserves, insurance, the property's ability to generate income. What they don't verify is your personal income. No W-2s, no tax returns, no pay stubs, no employment verification, no debt-to-income recalculations. Instead, the property qualifies, not you. And that's a huge difference. DSCR stands for Debt Service Coverage Ratio. Now I know, that sounds like something your accountant says right before you fall asleep. So let's simplify it. Imagine you own a rental property. The property brings in $3,500 a month in rent. Now let's say the mortgage payment, including principal, interest, taxes, and insurance, equals $3,000 per month. The lender asks one simple question. Does the property make enough money to cover its own payment? That's it. The formula is incredibly simple. Rent divided by mortgage payment equals DSCR. Let's do it. $3,500 divided by $3,000 equals 1.17. That means the property earns 17% more than its monthly payment. That's considered a positive cash flow property. Most lenders like seeing ratios between 1.00, 1.10, 1.15, 1.20, or higher. The higher the number, the safer the loan appears. Rent equals $3,500, mortgage equals $3,000, DSCR equals 1.17. Property pays for itself. Now let's flip it. Rent equals $2,700, mortgage equals $3,000, DSCR equals 0.90. That means the property doesn't fully cover its payment. Some lenders allow that, some don't. It depends on the investor program. Here's why investors absolutely love these loans. Imagine two investors. Investor A makes $400,000 a year, and investor B shows only $40,000 on their tax returns because they wrote everything off. Guess which one may have a harder time getting a conventional mortgage? That's right, investor B. Why? Because conventional loans qualify using taxable income, not actual cash flow. Many investors intentionally lower their taxable income. Great for taxes, terrible for qualifying. DSCR solves that problem. The lender says, we don't care about your tax returns. We care if the property pays the mortgage. Huge difference. Let's compare. Investor purchased a duplex. Purchase price is $600,000. Down payment is 25%. The loan amount is $450,000. The PITI payment, also known as a mortgage payment, is $3,950. The rental income for Unit 1 is $2,300. Unit 2 is $2,200. Total rent is $4,500. Now calculate $4,500 divide by $3,950. That equals 1.14 DSCR calculation. That's a very financeable property. Notice the lender never asks how much does the borrower make, where do they work, how much overtime, how many bonuses, tax returns, W-2s. Nope, the property qualified. Now, let's take things one step further. No-Ratio DSCR. This is where many people get confused. A traditional DSCR loan still looks at the property's ratio. A no-ratio program doesn't require the property to hit a minimum DSCR. Read that again. The property can break even or even lose money, and you may still qualify. Why, you ask? Because lenders understand something. Many investors buy for appreciation, not immediate cash flow. Think Manhattan, think Miami, think Los Angeles, think part of northern New Jersey. Many expensive markets produce negative monthly cash flow, yet investors continue buying because appreciation has historically been strong. So instead of focusing only on monthly income, the lender focuses on credit score, down payment, liquidity, experience, property quality, market strength, reserve assets. Example, purchase price $900,000, mortgage payment $6,500, rent $5,700. Traditional DSCR is $5,700 divided by $6,500 equals 0.88. Traditional lender says denied. No-ratio lender may say approved. Why would a lender even do that? Because lending is all about risk. Risk isn't determined by one thing. It's dozens. Credit score, liquidity, experience, loan to value, property condition, location, exit strategy, reserves, cash available, someone with 780 credit, 40% down, 18 months reserves, 20 rental properties is much different to someone with 620 score, 5% down, no reserves, first investment property. Even if the properties are identical, let's talk about what you'll usually need. Credit score, usually somewhere between 660 to 700 plus. Better score, better pricing. Down payment, 20%, 25%, 30%, sometimes more. Reserves, often 6 to 12 months, sometimes 18 to 24 months. Appraisal, required. Lease agreement, required. Market rent analysis, required. Title, required. Insurance, required. Entity ownership, often allowed. LLCs, corporations, trusts, huge advantage for investors. What properties qualify? Single family, condominiums, townhomes, 2 units, 3 units, 4 units. Many lenders also allow short-term rentals, Airbnb, vacation rentals, mixed use, condotels, non-wardable condos, large portfolios, blanket loans. Again, every lender differs. The pros, let's be fair, there are huge advantages. No tax returns, no W-2s, no DTI calculation, faster underwriting, easier for business owners, easier for investors, can close an LLC, unlimited finance opportunities compared to agency loans. Let's be fair, there's also cons. Now, here's the part many loan officers conveniently leave out. These loans are usually more expensive, higher interest rates, higher closing costs, more reserve requirements, larger down payments, sometimes prepayment penalties. Yes, prepayment penalties, very common. That means if you refinance or sell too early, you could owe additional money. Always ask, always ask. Here are some of the biggest myths. Let's bust a few of them. Myth number 1, no income required. Wrong, the property has income. Myth number 2, no credit required. Wrong, credit matters tremendously. Myth number 3, anyone qualifies. Definitely not. These loans still have underwriting, just different underwriting. Myth number 4, they're risky. They're not inherently risky. They're simply designed for investors. Who should use these loans? Perfect for real estate investors, house flippers holding rentals, self-employed borrowers, business owners, doctors, attorneys, CPA clients, retirees with investment income, people buying through LLCs, portfolio investors. Not ideal for primary residence, first-time buyers with no investment experience, borrowers looking for the absolute lowest interest rate. Here's a comparison with conventional versus DSCR. On your conventional loans, tax returns are required. DSCR, no tax returns. Conventional W-2s are required. DSCR, none. Conventional DTI required. Guess what? No DTI for DSCR. Personal income matters for conventional. Property income matters for DSCR. Limited investment financing for conventional. DSCR, much more flexible. Conventional, lower rates. DSCR, higher rates. Here are my final thoughts. Here's what I tell every investor. Don't chase the cheapest loan. Chase the loan that helps you buy the next property. Sometimes paying an extra 0.25% or even 0.5% allows you to continue growing your portfolio while conventional financing says no. That's not expensive. That's leverage. Remember, a loan isn't good because it's cheap. A loan is good because it helps you accomplish your investment goals. If you learned something today, do me a favor. Hit that like button because it helps this video reach more investors who are trying to build wealth through real estate. Subscribe because every week I break down mortgages, investing strategies, loan programs, and underwriting secrets in plain English, without the confusing banker jargon. And if you're thinking about purchasing your next investment property, refinancing your portfolio, or finding out whether a DSCR or no-ratio DSCR loan is the right fit, reach out to me. My team and I work with investors every day and can help you compare your options. Drop your questions in the comments. I'd love to answer them, and your question might even inspire my next video. Until next time, keep learning, keep investing, and remember, the right financing strategy can be just as important as buying the right property.